My name is Jake, welcome to the channel. In today's video, we're gonna do another Review My Pie video where I review subscriber portfolios. That's what we're gonna do in today's video. But before we dive into that, I wanna take just a second. I got a question on one of my previous videos. You know, whenever I start one of my videos here on YouTube, I start with this screen. I show my M1 Finance portfolio. My channel is not to just talk about my portfolio. Like, I just show this here so that for those of you that have been following the channel for years, you can kind of see, the progression, how my portfolio has gone up and down. I share this for, to be transparent, that I don't time the market. I just dollar cost average into the portfolio as much as I can. And I got a question, I think it was a week ago or so, about, hey, Jake, I'd love to see how your portfolio, the performance has compared with the S&P 500. So we'll dive into that really quick and then we'll go into the Review My Pie. So here over the last year, my weighted average return or my total return is just, negative 12.6%. So you take that by you looking at the market gains plus the dividend, that is my weighted return. Over the last year, my total return has been minus 12.5%, give or take. Okay, and so you might be thinking to yourself, well, that sucks. That's not very good. Well, if you compare it to the index, well, it's actually not that bad. So let's compare my portfolio with the overall market, with the S&P 500, the NASDAQ, and the Dow Jones indices. Okay, so right here, we're looking in Seeking Alpha, we're looking at the price chart. Let's look at the total return. The total return is with the dividend reinvested. The total return on the S&P 500 over the last 12 months is negative 15.83%. The overall benchmark for NASDAQ, it's down about 25%. And the Dow Jones is down 18%. Now, this is with the dividends reinvested. Now, what was my portfolio again? Oh, my portfolio, yes, it's down 12.6%, but the indices are down even more. All right, in today's Review My Pie, we're gonna answer one subscriber question. We're gonna look at three portfolios. The first is gonna be from a 29-year-old here in the US, the second, a 23-year-old here in the US, and then the third, a 55-year-old here in the US. I have a lot of subscribers here in the United States. If you're international and you're outside of the US, please send me your portfolio. I'd love to share them here on the channel. I get a lot of submissions from people here in the US. You don't have to have M1 Finance. You could send me an email, a spreadsheet. If you're anywhere in the world and you want me to review your portfolio, shoot me an email. The email's in the description below. I'd be happy to include it in a future video. As always, everybody, don't take what I'm saying as financial advice. This is just merely my opinion and it's just for your entertainment. As always, the timestamps will be in the description below, as well as the portfolio links will be in the description below. Now, before we dive into the video, I want to talk about something that's really important to me. And if you're not interested in this, you can jump ahead and you can go to the timestamps below. But I want to share something with all of the subscribers that have been with me for the last couple of years. For those of you that have been following the channel for a while now, I've been on YouTube for over 3.5 years now. And I have tried to make what I present here on YouTube, that it's authentic, that it's my opinion, that it's entertaining, that it's me. It's me. It's not someone else. And I've taken a lot of pride in what I've done, and that I've also not taken myself so seriously. I mean, I like to joke around and have fun. And for those of you that follow the channel, you know that. But I want to share some really exciting news. I've been on YouTube for 3.5 years, and I have finally decided to partner with a brand here on YouTube that I actually believe in. And I get reached out to by hundreds and hundreds of other companies, and I've always said no because I don't believe in the product or I don't feel genuine promoting something that I don't use. Finally, after 3.5 years, I've decided to partner with a brand here on the channel, and that partner is Seeking Alpha. I am so excited to be partnering with them. I've met with the marketing team over there. They are incredible. They love my content for whatever reason. It's nerdy and quirky, and it's just genuine in who I am. But the reason why I've decided to partner with Seeking Alpha is they do not want to change my content. They are going to give me full flexibility to continue doing what I'm doing, but they're still going to support my channel and my efforts here on YouTube. And I absolutely love that. And so I've put this off for 3.5 years. When I started YouTube, I thought to myself, I'm not interested. I want to be unique. I want to be genuine. And I don't want to be influenced by brand or sponsorship. And I finally found it. So if you've been with me following here the channel for a while now, I am so excited to be able to share this with you, because I'm not here, for those of you that have been following for years, I'm not here to make money on YouTube. I mean, YouTube is more of a passion of mine. It's a hobby. I make my money, my real money, at my day job. I work in software sales. That's where I make my money. But I wanted to share something very personal with you. Now, this is important because this is who I am. That the reason why I also really wanted to partner with Seeking Alpha was, yes, obviously the monetary incentive is absolutely great, but the real reason is so that we can afford to have in-home daycare for our baby. So my wife and I, we both work from home, and it's incredibly expensive to afford daycare, as many of you I'm sure are aware. By sponsoring with a brand like Seeking Alpha, we're able to afford daycare for our little baby boy. And by doing that, we're able to keep him home instead of sending him off. And this is going to be absolutely life-changing for us. So I'm super excited to share that with you. In all videos going forward, I'm not going to have a long, lengthy, explanation around why I'm doing this. I just wanted to do it once, so that for those of you that follow the channel and, follow me, I guess, I don't know, so that you can see why I'm doing this. And I don't know. I just wanted to say thank you, because I never started this YouTube channel to make money. And I'm just so grateful that there's so many out there that sit here, that come and turn on the channel every single week and watch my quirky, funny videos every week. So thank you all so much. But even after that lengthy description, I'm sure that there's going to be some troll in the comments who's new to the channel that's going to be like, no, you're just here doing it for the money, and you're selling out like everybody else. You're Meet Kevin 2.0 and oh my gosh. But it is probably going to look a little like this.
Maybe this will change your mind. Wow!
Sell out with me, oh yeah, sell out.
Good job.
Oh my gosh. Oh, that's a little baby Lucas. So everybody, all right, let's take a look at the first question here, and let's dive into their portfolios. All right, the first question here is from Wally. He writes, hey Jake, I recently graduated with a computer science degree and began working as a software engineer in Silicon Valley in San Francisco. I make $125K a year, and I've been investing $2K a month into Dividend stocks and save about $3K every month with Ally Bank Savings, with my Ally Bank Savings account, which has a better interest rate than traditional banks. Okay. I need some advice in regards to where to go from here. I want to be able to purchase a home, but with the housing prices in the Bay, it's almost impossible to buy a home. Should I continue having this mindset? I really can't imagine leaving the Bay Area, as I've lived here all of my life and my family lives here. Okay. So Wally, this is a really great question. You have, I'll just say it plain and simple, you have first world problems. Now, you're making a great salary, you're 23 years old, and you're making 6 figures. Okay, you're in an industry, and I know this industry very well because I work for a Silicon Valley company. I'm not a software engineer, I work in sales, but you have the potential in the next couple of years to double your salary. So your earning potential is going to be massive, a lot different than maybe somebody that's in the Midwest. Maybe that's somebody that is outside of an expensive cost of living area that only makes, $60K, $50K, whatever, right? So I want to make sure that you understand that you're in a really good spot. Now, comparatively, when you look at other people in the Bay Area, you're probably feeling like you're pretty poor. 6 figures in the Bay Area is not a lot of money. Now, I want to say, the first thing that comes to mind here is understand what your short and long-term goals are. Now, short-term, it sounds like you got your auto investing on, you're investing into your portfolio, you're saving money, you're saving more than you're investing, with the 3K. So what are you looking to do with that 3K? Now, in my opinion, if you know that you're going to be in the Bay Area, in my opinion, now this is just my opinion because I don't have a crystal ball, but if you know you're going to be somewhere, in my opinion, it would make sense to bite the bullet and purchase something where you're going to live. Now, the timing is going to be very important there, but maybe it can be a little bit different. Maybe you could house hack. You're 23 years old, you just graduated, you're working. Maybe you have a friend or a girlfriend or a couple of friends where you could buy a house where you could maybe have your parents co-sign, or you can save up the money and you can purchase it and you can be on the loan. But maybe there's a way that you could house hack, where you could have roommates for the first couple of years so that you could afford it, right? And I mentioned you're in a high, earning potential career where your salary can just snowball. So that's something that I would look at. If you know that you're going to be in the Bay Area for the rest of your life or for the foreseeable future, for the next decade, I think it could definitely make sense to purchase, but you don't have to. Another example of what you could do if you definitely want to get into real estate, and it sounds like this is a real estate question, what you could do is you could look at other areas of the United States. You could potentially purchase an Airbnb, outsource it to an agency to manage it for you, and you could go and visit that Airbnb outside of California for 1 month out of the year. Say, for example, you are like every other Californian and you're moving to Idaho. I'm sure everybody in Idaho is hating all the Californians right now, but that's a whole nother topic. But let's say you got a condo up in Idaho or in Jackson, in Wyoming or somewhere, and you outsourced it, but you still were investing into real estate, and then you use that as a vacation home, right? If you're dead set on buying a real estate, that could be an option for you. Now, there's one last thing that I want to say here. You're very, very young. You're 23 years old. 10 years ago when I was going through, was it 10 years ago or maybe 15 years ago when I was in high school? Back in the day, nobody was thinking about buying real estate. And now through the pandemic, through financial literacy, a lot of people are thinking, oh, I have to buy real estate. If I want to get ahead, I have to buy real estate. No, you don't have to. You can if you want. It's more and more important to understand what your life goals are. Focus on those 3 things. Don't get into consumer debt. Don't pay for things more than, don't buy things on credit, and look where you can save money, house hack, etc. So those are some things that I would, consider. But if you're 23 years old, man, I would not be stressing buying a house right now if you don't have to. So that's just my opinion. I'd love, if anybody else has a different opinion, please share it in the comments. I would love to hear your thoughts, but that's just kind of how I view it. So thanks for the question. Appreciate it. All right. The first portfolio is from Dan. Dan writes, hey, Jake, just got to say, I love the channel and I wish you and your family all the best moving into the future. Dan, thank you so much, man. Appreciate it. My name is Dan and I'm 29 years old from the US. I'm currently working around with different portfolio ideas to begin investing in earnest once I turn 30 next year. With this pie, I want to be ready to move to a part-time job at 55. So my time horizon is long-term. I'm not looking to fire, just the ability to work less and still live comfortably. Hell, if I could get that by 45, that would be wonderful. I really like that mindset, by the way. As far as retirement goes, I'll be more than all right, but this will hopefully cover a lot of the gaps I could run into. Any and all advice and or criticism would be greatly appreciated. I will admit that I am invested in these companies because I did brief skim of their profitability, future viability, plus I know and trust these companies to continue into the future. However, I'm already feeling that a rebalance of percentages will be necessary in the future. Thank you ahead of time and hope to see my pie in the future. Dan, all right, well, Dan, this is great, man. So you're 30 years old. You're thinking about FIRE, but more about the financial independence. I think most people fit your situation where it's all about the freedom to choose what you do. It's not that you're lazy and that you want to sit on the beach all day. It's that you don't want to have to make decisions because you have no other choice. Okay. And I think you're thinking about this at a good time. 29 years old is a good time to think about this. 45, 50, you're still very, very young. All right, let's take a look at your portfolio. So we're not seeing the stats here further back, but we can see this dividend yield and we can see the expense ratio. So you're talking, 45, 55. So this is going to be likely in a taxable account. So this is not a sheltered account like a Roth IRA or a 401k. This is a regular brokerage account. And because this is a regular brokerage account, I see a glaring red flag. Does anybody want to guess what that red flag is? If you have a long-term time horizon and this is a taxable account, this is your red flag. 6% dividend yield? Why? Why do you want to pay taxes for the next 25 years? Why? There's no reason to do it. When a lot of people talk badly about dividend investing, one of the reasons why is the tax disadvantages that come with dividend investing. Yes, there's qualified dividends, you get a better tax rate, but why pay taxes when you don't have to? Okay, so that's the whole argument here. So let's take a look and see what you have in here. You have it set up actually similar to how I have my portfolio. Okay, so what do you got? You got SCHD, VYM. These are great ETFs. I own both of these. I really like these. You got Sunco. You got so you got a REIT, you got another REIT. We'll get back to that in a second. You got Procter & Gamble, Comcast, Altria Group. You got another REIT, Western Union, Walmart, and H&R Block. What do you got in here with weapons? Okay, so you got some defense companies in here. Okay, the defense companies are all qualified dividends. That's fine. Okay, so the first thing that I would recommend is Omega Healthcare. There is no reason, unless I'm going to go off on a limb here and say there is absolutely no reason that you should be investing so heavily in Omega Healthcare. With your time horizon in a taxable account, this is the wrong choice. The same thing with Ready Capital Corporate here. I'm not as familiar with this company, I will admit, but yeah, I don't need to be familiar with it. I can already tell you, 16% dividend yield. This is not the right approach, dude. So you definitely want to revisit this. All of your REITs, you may, if you absolutely are dead set on keeping them, keep them. That's fine. But for the next 10 years, 15 years, put this at 1%. Put it at 2% if you want. Don't make this such a large percentage. Okay, this is the wrong approach. Realty Income, great company. I would not raise this more than 5%. In my honest opinion, Dan, you're 30 years old. I personally, I would not have Realty. I would not have Omega Healthcare in this REIT in here at this high of a percentage, maybe 1 or 2%. And what that's going to do is it's going to lower your dividend yield, but that's a good thing because then what you can do is you can take the other remaining 7%, if you keep 1, and you can put it into SCHD or you can put it into Walmart and these other high growth companies. The important thing that you have to understand is the total return. Okay, the total return is absolutely key, and you get the total return from a combination of the capital appreciation plus the dividend. And when you have a long time horizon, your dividend growth rate can just snowball your returns and your dividend growth over time. Okay, now here's what I would recommend. If you're dead set on keeping these REITs in here, you can always increase the percentages in 10 years, in 20 years. And you're not paying taxes on the dividend for the next 15, 20 years. You follow me? That's incredibly important. Now, if you were 55 today, I would say, rock on, this is great, but you're not. And even if you're 30, and if you were to write in your email, Jake, I'm 29, and I want to live off the dividend in 3 years, I'd say, heck yeah, man, this is the way to do it. Okay, it really depends on when you plan on living off the dividend or supplementing your lifestyle with the dividend. Okay, that's the key thing here. So thank you so much for sending over your portfolio. Highly encourage you, make some changes, revisit or consider making some changes, revisit those REITs, try to get this dividend yield down quite a bit. And if all possible, if you have a Roth IRA, throw these in your Roth IRA. I mean, but even then, I would not keep this at a high percentage because the total return, regardless if it's in a Roth or a taxable account, tax sheltered or not tax sheltered, you want to focus on the total return. The total return is going to be a bit higher with some of these other growth in individual companies or with an ETF like SCHD. So thank you so much for sending over your portfolio. I hope that helps. If you have any other questions regarding this, leave me a comment in the video here, and I'll respond. And maybe somebody else here in the comments can respond as well. Thank you for sending over your portfolio. All right, the next portfolio is from Noah. He writes, "Hello, my name is Noah. I'm 23 years old, turning 24 in 5 months, and would love it if you could rate my pie." I mean, short and sweet, straight into the point. All right, Noah, so let's take a look at your portfolio here. You say you're 23, so I don't have your time horizon. Your age, as I was just mentioning, is only half of the equation. I need to understand when you plan on using the dividend, but I'm going to assume if you're 23, most 23-year-olds probably have a 20-year time horizon. That's what I'm going to assume, okay? So looking at this from a 20-year time horizon, or longer even, you got SPLG, you got SPDW, SCHD, SPYD, and MGV. Okay, so couple of things that come to mind. I don't know if this is a Roth account or a taxable or tax sheltered account. MGV is great for my dad. My dad is in his 60s and he's looking to live off the dividend today. You're 23. I don't know if MGV is the right approach for you. Now, mega cap value is going to do better in 2022 than growth, like pure growth. But over the next 20 years, it's not. It's going to, in all likelihood, based off of 100 years of averaged returns, mega cap value doesn't have a higher, the total return is lower than, for example, with the S&P 500. So that's something that you may want to consider. I like the brands, I like the companies in this ETF, but questionable. SPYD is good if you're retiring in the next couple of years. I actually like SPYD for me. Maybe in my Roth IRA, down the road, there is a higher percentage to real estate. So you will be paying higher taxes in SPYD than you will with SCHD. So because of that, I like SCHD more than SPYD, especially in a taxable account. Okay. So very, very important. And if you're not sure what I mean by that, hopefully this will trigger, some interest for you to go research this. Go look at SPYD and look at the sector breakdown, and look at the sector breakdown of SCHD. SCHD, no real estate. SPYD, real estate. Now, the other two here I'm not as familiar with. So SPDW is an ex-US, so this is an international ETF, which is great. And SPLG, I actually don't know SPLG. Let's take a look at SPLG. I'm not familiar with this one. This is the S&P 500. What is the index looking at? Is this just a pure S&P 500 ETF? It looks like it is. What is the expense ratio? Because I'm not familiar with this ticker. Expense ratio. Okay, so this is an S&P 500, the Series Trust. Interesting. Let's do one thing really quick. And let's chart it with VOO. I'm just curious to see how it compares to VOO. Is it the exact same thing? Yeah, you can't even see the two colors here. It's the exact same thing. So it's the exact same thing as VOO. So you got the S&P 500. I really like that. So all in all, I like the fact that you have the most focused on the S&P 500. I like the international piece. You're a little bit more diversified. SCHD, I like that. So the only two that I would recommend you revisiting are SPYD and MGV. Okay. But yeah, all in all, Noah, I think most people would be better off doing something similar to this than trying to pick 50 individual companies, right? So I actually I kind of like this, but yeah. So Noah, thank you so much for sending over your portfolio. I appreciate it. All right, the last portfolio is from RP. RP writes, Hi Jake, a great thanks for your knowledge transfer. I love your YouTube channel, not only with the great content, but presented in a quick and enjoyable way. Well, thank you, appreciate it. I'm 55 years old, new to investing. Here's my investment situation. I've installed M1, but face the dilemma of creating my pie and would like to start with right on the right foot. If possible, I would like to retire in 10 years, and I plan to put the initial $60K and $2K a month for the next 10 years in M1 finance. Okay, can you please let me know your thoughts on my suggested fund allocation? Well, hey, RP, thank you so much. I really appreciate it. First things first. So you're 55. You're going to be over the age threshold with a Roth IRA, for example. So I hope that this is either in a Roth IRA or it is in addition to a Roth IRA. So when you're 55 years old and you're investing, the number one thing is getting your account correct. That's the first thing that you want to focus on. The account type is really, really important. You don't want to pay more taxes than you have to, and that's why it's very, very important. Okay, so you got dividends, 75%, and you got stocks. Okay, so I'm assuming these are ETFs and these are individual companies. You got CDC. I'm not exactly sure what CDC is. Some of these I'm familiar with, some of them I'm not. SEHP, you got oil, S&P 500, real estate, utility, Vanguard, high dividend, and the XLE. This is energy, if I'm not mistaken. The majority of them I'm familiar with. I'm not exactly sure with some of the other ones. I think this is actually fine. So a couple things that come to mind. The ETF holdings here, I like that you don't have 50% into utility, right? I actually like that. I'm glad that you don't have 30% into energy, for example. I think the one thing that you could consider doing is maybe looking at, okay, well, what is your goal in the next 10 years? Would you rather have more dividends and not sell your shares? Or would you rather have a higher portfolio value and have the S&P 500, and then you could either sell the S&P 500 and buy more, high dividend ETFs or whatever. So all in all, I think that this is not a bad approach. The one thing that I would tell you is try to, when you're reviewing your portfolio, think of ways that you could simplify this, if at all, right? So if you wanted to simplify certain things, what could you do? Because when you invest in the S&P 500, you're getting exposure to the Vanguard energy ETF, and you're also getting exposure to utilities. The question is what it sounds like, or it's not really a question. What it sounds like is you want extra exposure to these sectors, and that's why you're buying these sector-specific ETFs. Okay, which I think is fine. Your stocks here, you got American Tower, you got AXP, you got Tesla, Amazon, and Bank of America. You got a lot in Tesla. Whew. In my opinion, this is just my personal opinion. Okay, so some random dude on the internet. Okay, I think this is a lot of exposure to Tesla. You're already getting exposure to Tesla with the S&P 500. Tesla is already in the S&P 500. I think this is a little bit riskier for my taste. I personally, if I was talking to my dad or my friend and saying, hey man, you might want to reconsider that. I'd be curious, unless you work at Tesla and you have really good understanding of Tesla and the outlook of Tesla, for me, it's just a little bit too risky. And, it's not just Tesla. It could be anything. If you invested 55% into Bank of America, I would say the exact same thing. Or if you invested 55% into Apple, I'd say the same thing. I just don't like having so much exposure into one company, because if something goes south with that company, it's like really catastrophic. And I don't think that that's necessary. You don't have to have that. And that's why I'm not the biggest fan of it. But all in all, I like that you have 75% focused on dividends. I would definitely recommend looking at which account type you're investing. I like the fact that you're investing $2,000 a month. I think this is great. Thank you so much for sending over your portfolio. I really, really appreciate it. Thank you so much for watching, everybody. I hope that this video was helpful. The main thing here with these Review My Pies that I'm noticing over and over again is you have to understand time horizon. You have to understand if you're 23, you could look to live off the dividend or supplement your income at 25, at 29. So you have to understand that your age is just part of the equation. So you really want to ask yourself, based off of your time horizon, when you plan on living off the dividend, and should you focus on a higher dividend today or a lower dividend today based off of that time horizon. And that's the beautiful thing about investing is everyone is in a unique situation. And when you read something online, you read a blog, you read a comment where somebody is bashing on an idea, you have to understand that everyone's in a different time horizon, right? And so there really is not a one size fits all answer to this whole equation of investing and what's the right approach. Because in my opinion, as I've shared many times, there's many paths that can lead to success. And it really just comes down to finding your path. Thank you so much for watching. We'll see you in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.